Hello and welcome to the Commodities Institute podcast. I'm Emily Costa and today is January 13th, 2026. Thank you for spending part of your day with me as we slow things down and really unpack what is shaping global commodity markets right now. Today's episode is one of those moments where geopolitics, physical supply chains and raw numbers all collide. We are seeing the reawakening of Venezuelan oil exports under extraordinary circumstances, a stunning surplus in US corn that is rewriting the agricultural balance sheet, and an intensifying global race for the metals that underpin artificial intelligence, clean energy, and national security. Along the way, power markets, shipping constraints, and trade politics are quietly but decisively steering outcomes. Let me start somewhere unexpected with agriculture, because the latest data out of the United States sets an important tone for risk appetite across commodities. The US Department of Agriculture just confirmed that corn stocks as of December 1st reached more than 13 billion bushels, the highest level ever recorded for that date. That number matters because it is not just large, it is larger than almost anyone anticipated. Farmers harvested a crop of more than 17 billion bushels last year, with yields coming in stronger than forecasts despite concerns about late-season dryness. For growers, this is a painful paradox. Bigger harvests usually sound like good news, but in this case, they reinforce a market already struggling with low prices and rising costs. Corn futures slid sharply after the report, dragging soybeans and wheat with them. Soybean production also came in higher than expected, while exports are being revised lower as trade tensions continue to weigh on demand from China. The result is a farm economy under real strain, even as government aid programs attempt to soften the blow. When you zoom out, abundant grain supplies globally are a reminder that food markets, unlike energy, are not facing scarcity, but rather profitability challenges. Now contrast that with oil, where scarcity, access and control are very much the story. Venezuela, home to the world's largest crude reserves, has suddenly re-entered the market after the US-backed removal of President Nicolas Maduro earlier this month. What is remarkable is not just the speed of this shift, but who moved first. Instead of American oil majors, it was global trading houses, Vitol and Trafigura, that secured the initial deals to market Venezuelan crude. This tells us a lot about how the modern oil market really works. Trading houses thrive in complexity. They have fleets, financing structures, and a tolerance for legal and operational risk that publicly listed oil companies simply do not. Washington needed Venezuelan oil flowing quickly so export revenues could support the interim government in Caracas and stabilize the country. Traders could execute at record speed, securing licenses, lining up ships and arranging buyers while majors hesitated. There is also the shadow of Venezuela's massive debt, well over $150 billion. Creditors, including ExxonMobil and ConocoPhillips, are still pursuing compensation for assets expropriated decades ago. For US oil companies, the risk that revenues could be seized by courts or creditors is a major deterrent. The US government responded by issuing an executive order shielding oil sale proceeds in Treasury-controlled accounts, but reputational and compliance concerns remain. Meanwhile, these early Venezuelan cargoes are already being offered beyond the United States. Traders are approaching refiners in India and China with discounts to Brent that reflect both quality and political risk. Venezuelan heavy crude needs diluents like naphtha to move and process, and traders are supplying that too. The return of these barrels is already capping oil price gains globally, offsetting fears of disruptions elsewhere, including Iran. It is a reminder that geopolitics can add supply just as quickly as it removes it. Staying with energy but shifting gears, liquefied natural gas markets are showing a different kind of strain. Venture Global, one of the largest US LNG exporters, has cut its profit forecast due to volatile pricing and shipping constraints. Limited vessel availability in the Atlantic has squeezed margins, highlighting how shipping is no longer just a background cost but a strategic bottleneck. Even with strong export volumes, higher transport and spot market exposure can quickly erode profitability. Those shipping dynamics echo across dry freight as well, where farmers and energy producers alike depend on reliable logistics. When freight tightens, it feeds back into commodity pricing, sometimes invisibly, until suddenly it is the dominant story. Now let's move into metals, because this is where long-term narratives are crystallizing. Mining giants are maneuvering for position as copper demand accelerates, driven by data centers, electrification, and renewable energy. Talks around a potential takeover of Glencore by Rio Tinto have electrified markets, but BHP, often seen as the natural counterbidder, appears content to wait on the sidelines. BHP's focus remains firmly on copper quality and strategic fit, underscoring how selective miners have become. Copper is not just another industrial metal anymore, it is infrastructure for the digital age. The same applies to rare earths, where governments are openly acknowledging strategic vulnerability. Finance ministers from the Group of Seven and allied nations recently met to discuss reducing dependence on Chinese supply chains for critical minerals. China currently dominates refining for many of these materials, from lithium to rare earth elements, giving it immense leverage. Ideas on the table include setting minimum prices to support alternative supply, increasing public financing, and accelerating recycling. What stands out is the tone shift. This is no longer about efficiency alone. It is about resilience, labour standards, and national security. Europe, Japan, and the United States are all signalling that diversification will come with costs, but those costs are increasingly seen as necessary. Power markets reflect similar tensions. In the United States, offshore wind has become a political battleground. A federal judge has allowed Ørsted to resume work on its Revolution Wind project off Rhode Island, rejecting arguments that national security concerns justified halting construction. The project is nearly complete, and delays were costing millions of dollars per day. This ruling does not resolve the broader debate over offshore wind, but it reinforces how courts are becoming key arbiters in energy transitions. Carbon and power policies are no longer abstract frameworks. They directly affect investment timelines, supply expectations, and market confidence. Developers need certainty, and right now that certainty is fragile. Before we wrap up, let me briefly return to soft commodities with coffee, because it offers a subtle but telling signal. Global green coffee exports rose nearly 5% year-on-year in November, driven almost entirely by a surge in Robusta beans, especially from Vietnam. Arabica exports, by contrast, declined. This shift matters for pricing, for blending strategies, and for consumers, as instant coffee and espresso blends lean more heavily on Robusta. It is a reminder that even within a single commodity, the story can diverge sharply by quality and origin. So what ties all of this together? Whether we're talking about Venezuelan oil, Midwestern corn, Chilean copper, or Vietnamese coffee, the common thread is control. Control of flows, control of logistics, control of rules, and ultimately control of risk. Markets are rewarding those who can move quickly, manage uncertainty, and operate across borders and regulatory regimes. As we head deeper into this year, expect more volatility, but also more clarity about who holds the real leverage in commodities. It is not always the producer with the biggest reserves or the farmer with the biggest harvest. Often, it is the intermediary, the policymaker, or the ship owner who shapes outcomes. That's all for today's episode of the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa. Thanks for listening, and I'll be back with you tomorrow.